welcome to Taking Stock, the show where we take stock of the week gone by and prepare you for the next trading week that's coming up ahead. I'm Harsha Upadhyaya and with me is Lata Venkatesh. Hi, Lata.
Hi, Surabhi. Before we take stock of the market, first let's apprise our viewers of the top market headlines of the week. Markets dither at higher levels. Nifty ends the week mildly in the red. Sensex ends with very mild gains. Tata Power and Reliance are the saviors with some gains, while Gale and Lupin are the top losers on Friday. Mid-cap index has underperformed for the week, ends over 1.5% in negative territory.
Market regulator SEBI lends its shoulder to resolve NPAs, eases share pricing rules in stressed asset cases, allows hedge funds to invest in commodity derivatives but with certain riders. Also tightens norms for participatory notes, fixes a fee on investments through this route. Bankers send 7 defaulting companies to the bankruptcy court out of the 12 singled out by the Reserve Bank. Of these, stocks like Monet Ispat and Amtech Auto actually gained on hopes of a quick resolution to their debt. Okay, well, before we start off with the Q&A and invite our guests on the show, Lata, your sense on the market itself, the kind of range-bound session we had throughout the week, but the fact that towards the end it seemed that the market was perhaps really tiring out.
Yes, there certainly was a fear of heights. But before I make some observations on our markets, I just want to read out this quote we got from Lawrence Belanco, the chartist from CLSA. He seemed to capture the mood not just of Indian markets but of global markets. He says he's cautious on global markets, says many of their momentum breadth headline indices as well as credit spreads are flashing their strongest warning signals since early 2015. He says this is not the time to be adding to risk. In his best case scenario, the corrective period takes the shape of a trading range over this summer as the market rotates out of the overbought outperforming growth and yield sectors like, say, technology in the US, that is, utilities and staples, and goes into reflation themes, in particular small caps and financials. So Belanco basically says a break below 2.1 to 2.16% on the US 10-year yield, or Brent oil breaking below $41 to $43 support levels would likely lead to a steeper corrective decline over the coming 3 months. Now, this is what I thought captures the essence of the markets globally as well as in India this week. There seems to be a fear of heights everywhere, and Belanco thinks that all of summer, the best scenario is if the range continues. So obviously the worst case scenario is it breaks through the range rather sharply. In India itself, why Lawrence's theme is worrying is that we even underperformed other indices. Asian indices largely have done better than us. They have ended the week with about 0.5%, 1/3% in gains. European indices also marginally in the gain. We are the ones ending slightly in the red. So we have underperformed clearly. And within that itself, our high-performing sectors, oil and gas clearly seems to have given up its performance. And motor cars, I mean, Eicher or not Hero Motor so much as Maruti, all these stocks which really were our consumption theme and the theme which gave maximum gains started losing. Likewise, the non-bank finance companies in the mid-cap space have started losing since Thursday when the markets peaked off. So probably we are into a phase of profit-taking.
Okay, well, on that note, let's also invite our guest onto the show. Joining in to take stock of the market in this week gone by is Harsha Upadhyaya of Kotak Mutual Fund. Harsha, good to have you on Taking Stock. So it's been quite a week, which has divided people on the street as to whether this is just a, bit of a pause, bit of consolidation, or whether the market has actually made, as the chartists say, a double top. What's your sense?
Surabhi, as you said, I think market is clearly struggling to move up. In the past few weeks, it's been very clear that while the money is getting invested into the markets, you are not seeing a mad rush in terms of index moving up one way. There has been some amount of profit booking in some select sectors and stocks. To our mind, I think this is a healthy correction that's there in the markets today. Whether it gets deeper or not, it's too early to talk about that. I think clearly there was a perception that at least in some pockets, the overvaluation was really beginning to haunt investors. I think that is where most of the vulnerability is, and one has to be cautious in some of those overvaluation zones.
Harsha, what would you do, for instance, say on Monday or, okay, Monday is a trading holiday, on Tuesday and thereafter? Are you likely to buy at the current dip itself, or looking at the way the market has behaved, would you move a little more into cash?
See, Lata, at Kotak Mutual Fund, we have a policy of not keeping more than 7.5% maximum in terms of cash in any of our equity funds. So within that leeway, yes, we have been very gradual even in the past whenever we felt the valuations are a little higher from a very short-term perspective, or if there was any event that was impending, so we were clearly waiting out that period. So that we could continue even going forward. But if we keep getting flows more than this 7.5%, then obviously we will have to get invested into some of the relatively better or less risky sectors.
But is there a chance that you will not get the cash? Does retail look scared at all? After all, what are we? Just about 1.2% or 1.3% away from the all-time highs.
We haven't seen any change in inflows at our end at least, and I'm sure that is the case with the entire industry. The flows continue to remain very, very consistent and strong. So I really doubt whether even if there is some correction in the market, whether that will change. And going by what happened in 2016, whenever the corrections happened in the market, in fact, the inflows increased. And if that continues, then I don't think there will be any reversal inflows anytime soon.
So, Harsha, you mentioned that obviously the mandate is not to have more than 7% cash in the funds. Where would you deploy the fresh money that you're getting in right now? You said you'd prefer to be in less risky areas of the market. So, could you elaborate on that?
See, clearly, we are not going to chase just the momentum or the stocks where there has been good business growth, and hence stocks are trading at very high expensive valuations. So I won't get into individual stocks, but clearly we are not looking at certain segments in the market. For example, some of the housing finance companies, some of the consumer discretionary names have really run up in the recent past, and I'm not saying that all of them are expensive, but clearly you have to become more stock specific in those areas, and that's what we are trying to do. And at the end of the day, we have to look at overall portfolio earnings growth and portfolio valuations rather than the entire market, because at the end of the day what matters to us is how is our portfolio constructed, and if you are able to keep portfolio valuations at a sober level, then we are fine. So maybe there will be few stocks which are at expensive valuation, maybe there will be few stocks at very attractive valuations, but at the end of the day, overall portfolio has to be a reasonable valuation oriented portfolio in our sense.
Okay. Are savvy investors, large investors like say maybe corporates who are putting excess money with you, or HNIs, already worrying about things like, say, GST maybe, or the first quarter numbers, or even whether growth is really taking off? Are they showing any signs of turning turtle, holding back money?
No, we haven't seen any reversal in money flow at any level, whether it's retail or high net worth individuals. So to that extent, money flow continues to be strong. Yes, there have been some concerns in terms of whether there will be hiccups in and around GST implementation, whether there will be rundown of inventory during this period, etc. But those are, I think, smaller issues to contend with. What we are looking at GST is it's not going to fundamentally alter the demand dynamics in the short run. If that is so, if there is a rundown of inventory in June, then definitely that is going to get filled up in July or a little later. So between June and September quarters, I think that should get adjusted overall, and very unlikely to see any fundamental adverse impact on the demand per se, just because of GST implementation.
Okay, there are two.
So that's how we are viewing this entire event.
Okay, sorry. There are two sectors on which the street seems somewhat more sharply divided. The ones that have given a lot of returns: housing finance and microfinance. Housing finance, the fear is that after all, it is a commoditized business. Thin margins, very thin margins. So should they be valued so heavily? As well, microfinance, farm loan waiver or demonetization, are their collections under threat? How are you looking at valuations in both these spaces?
In both spaces, I think one has to be very, very stock specific and cautious in approaching these sectors or subsegments of financial sector. On the housing finance part, it is clear that from a medium to long term perspective, there is policy push. There is going to be enough money around the affordable housing theme, and hence growth is going to be quite strong in the medium to long term. But the point is, some of the names have already discounted some of this expected future growth in the valuations today, or maybe more than immediate expected future growth. So that is where one needs to be cautious. I believe that not all of the housing finance companies can be looked at from the same risk metrics. There are companies which are not entirely retail in their approach, but still getting similar valuation, and we all know that some of the chunky loans within the sector can have different risk parameters associated with that. So we need to differentiate between housing finance companies and then take a view about the investments. On the MFIs, I think some of the issues are already well known. We have seen issues from Maharashtra, UP, maybe some parts of South India as well in the past in terms of MFI loans turning bad, and some of that will get public during the June quarter results, and definitely there is pain there. And the recent trend of some of the state governments announcing farm loan waivers could also add to risk, although it is too early to comment anything specific to farm loan waiver and its impact on the sector, but I think that is just adding more risk to the sector. So one needs to be cautious even there.
Harsha, are you in the camp that's looking for bargains in IT and pharma?
No, Surbi. We are completely underweight on these two sectors. The headwinds are still very, very large headwinds for these two sectors. And the recent currency appreciation is also not going to help the sector. The margins are definitely going to be under pressure. Most of the expectations in the market today haven't really taken the current rupee exchange rate. Most of them are still using maybe 67 to a dollar kind of exchange rate. Definitely, whether it's June quarter or September quarter, we are likely to see margin pressure in both these sectors, which is not in the analyst estimates. So clearly, we are trying to be cautious in this sector even now.
All right, Harsha, it was a pleasure speaking with you. Have a great weekend and an extended weekend at that. I think Harsha is expressing the quandary of the market, as it were. He's afraid of the valuations at these levels, but what will I do if I keep getting the money, is what he said. I cannot stay in cash, and that's perhaps best reflected by other marquee investors as well. In fact, on that note, we did speak to a gallery of marquee investors this week. We had Anup Maheshwari, Neelkanth Mishra, Samir Arora and Kenneth Andrade on our channels. Here's a slice of what they told us. We are back in a break.
I think the key ingredient right now for this market to look forward to in terms of stocks particularly is those which are demonstrating fairly high growth and a good runway of growth over the next few years. In the short run, you'll only see the negative effects of GST in the next 2 quarters, almost like demonetization. So you'll have some very erratic earnings across the entire spectrum.
No, I don't expect the earnings to improve over the next 3-4 quarters. I think the momentum still looks quite weak. I think the broader economy is unlikely to pick up steam in the next 3-4 quarters because we are going through some very structural transitions. I call it a house under renovation. So we are sort of breaking down a lot of vicious cycles we were stuck in and then rebuilding in what hopefully will be a much healthier and a much faster growing economy.
We have never had India really doing well independent of the world. It may outperform or underperform. So we think the world is okay, so we are okay. Our net is about 68, 69%, which is higher than normal, but we can switch it off if needed, but there's no, I don't feel that, by the way, a market has to go up every day for me to feel that it is a good market. For this month, actually if you leave out the index, if you look at average stock, they'll be up to 3%, at least that's what our MAV seems to show. So broadly speaking, it's been a good month so far.
For us sitting in financial markets, it's a great opportunity in the near term. The organized players will consolidate markets. But if the system actually does that, in the long term, you might just have a demand concern over the next decade or probably longer than that. The rural franchise will become fairly large.